Welcome back. You're watching Stock Watch with me, Zinati Guma, and joining me to take your stock-related questions is Devin Shutte from the Robey Group. We are pre-recording today's episode, but do continue to send your questions on email at stockwatch@bdtv.co.za or via SMS on 41392 or on X using the hashtag StockWatch. Thank you so much for your time. Devin, I feel like we've been here before because the same things that are keeping markets on edge have been the same things that pop up, once every few months. Is this the time to be going into stocks that are exposed to oil and defense and gold and all of that stuff? That's safe stuff.
Yeah.
I guess.
So the safe stuff. Yeah, it's a good question. I mean, I think for a long time now, you and I have been speaking about the inflation and monetary policy. And I think added to that more recently has been the US labor market and what shape that is in and how that's affecting monetary policy. And then we still got these two active wars going on at the moment. One in the Middle East looks to be escalating somewhat. So yeah, there really is a lot for investors to ponder. But what I will say is that the market is in an incredibly bullish mood. And I think there's a number of factors driving that. Obviously, interest rates now, we've got confirmation that they are moving lower. It's not just theoretical, particularly the Fed is obviously the most important there. It also looks like the US economy is still in reasonable shape. And that's very important for a number of industries and all of that. So that's good. And then surprise, surprise, China. I mean, you and I have also spoken about that market for a long time. Looks like they've pulled out part of the bazooka. And clearly the markets acted almost instantly there, but kind of put all of those together, and I think the market's feeling pretty good. It's not to say it's without risk by any means, but yeah, definitely moving higher, and the returns have been pleasing for investors so far.
Well, talking about pleasing returns, because those have largely been coming from Nvidia for the last few, this year actually, maybe even part of last year. And actually, we haven't had a question on US tech and particularly Nvidia in a while. Can you give me your opinion on Nvidia? Is this a time to buy these shares, or are they considered to be too high at this stage? And what is your opinion on the share price going forward? Well, I mean, going forward, I guess that will depend on whether they continue to surprise to the upside. But just your opinion of, the shares, if it's time to buy or if they're too high.
Yeah, Zenati. I mean, I think I would be cautious here. Not to say that the company hasn't done incredibly well and generated sales far in excess of what the market has expected quarter after quarter for a while now. But I think the problem you have is very much on the valuation basis, that this is priced for perfection. And even though we have the CEO coming out and saying that the demand for their new chips is absurd, which it probably is, I think in any area of the market where you see such intense profitability from one company, that attracts massive competition. And we know there's a lot of chip manufacturers globally that are really racing to catch up. They are still maybe quite a bit behind, but my sense is that increases, and you're paying a lot of money right now to back Nvidia, that they stay ahead of the pack, and I'm not sure that's worth the risk. So good company, but I think I'd be cautious on entering the stock right now.
All right. We'll talk about a stock that has accelerated. Let's go into a company that is a mobility service company, and that is Zeda. Your view to enter Zeda at these levels as we approach summer?
Yeah, I mean, look, you are going to see the demand for rental cars tick up in kind of the peak tourism season. The forecasts are that we're going to have a very good tourist season here. Suddenly, South Africa is back on the map for investors and tourists a lot more. We've got great weather, we've got great attraction. So yes, I think that will happen. Whether you time the investment into this to go in there, I'm not so sure. I think you've got to look a little bit more under the company. I think they have had their issues. The share price hasn't done much for a while, but Yeah, I think I'd be cautious on it. It's not one we're rushing into. I think, there is still sufficient supply there, and we haven't seen demand outstrip that yet. So, yeah, I'm waiting on the sidelines on that one, Zenati.
All right. Well, let's get into more questions. And this is on banking. I actually have two on financial services companies. So, Investec first. Your view on Investec for the next 3 years?
Yeah, I mean, they've done really well, haven't they? And it's that really nice blend they've got between the wealth and investment, the private banking and the corporate banking, and also the geographic spread that actually really works for them between Southern Africa and the UK. So, yeah, you're looking at a well-capitalized bank, a really, really strong brand, the ability to execute well, and, yeah, highly profitable, been growing revenues there, and, the shareholders have been rewarded as a result. Going forward, I think it might not be as good a period as it's come from, just purely because we've got Europe and the UK potentially slowing down somewhat there. And so as a result, I think some of that profitability might come under pressure, but we like it. We still think they've been able to grow revenue and earnings, through a very difficult time in South Africa and Europe, I might add. And yeah, so quite a dependable one. One we like, and nice return on equity for shareholders.
Even Capitec, I think a lot of the stuff that you said on Investec, particularly when it comes to the growth and the rewarding of investors, you also get that with Capitec. Should one buy Capitec at current levels? And when can one expect any pullback?
I think the market's been asking this question for 10 years. It's always looked expensive and just keeps on going up. I mean, it's such an incredible success story, isn't it? And I mean, there's just what I love about the business is they just keep on reinventing themselves. And the latest results, what was massively impressive for the half year is that their value-added services, so that's selling prepaid electricity and data, they are enormous. They generated 2 billion rand from that, which is just incredible. And they're now between kind of a quarter and a third of the entire market in South Africa just for that. They continually migrating their client base onto the mobile app. They're adding other services like insurance and that. So yeah, they're just executing incredibly well. They're less hamstrung by legacy IT systems than some of the other banks. But to your viewer's question, when do you buy this? So Nadia, I don't know. I mean, it's looking expensive. It's looking like it could justify it, but yeah, the risk is there that, again, similar to like an Nvidia, price for perfection, and if they do have a misstep, the market will punish them. So,
and which we have seen in some periods as well.
That's correct.
Yeah. Well, still sticking to financial services, 91 going into asset management. What do you think of 91 at the current price?
Yes. So asset managers are great businesses in that they're very asset-light businesses. So you really just got mostly human capital there, portfolio managers and the like making the decisions. And really they're very closely intertwined to financial markets, right? As financial markets do better, so their assets grow, so they're able to hopefully generate more performance fees and their management fees in that regard. And we've had a very good run in global financial markets for quite a while now. So it's a model we like. I think 91 has, maybe struggled a little bit compared to maybe some other global asset management peers, but it's a great dividend payer. I mean, I think it's up to almost 7% there. The valuation is not demanding by any means. I think it's single-digit PE there. And yes, I think, they're one of the larger global asset managers now, not just a local asset manager. And I think that scale gives them the opportunity to really get certain mandates with bigger clients and the like. So yeah, one we like. I think it's one to look at. And yeah, I don't think you have to hold back from a valuation perspective.
All right. Well, let's get into PGMs. Your view on Sibanye-Stillwater, is it still a buy with the recent rally? Let's actually start off with that. I actually never get a PGM counters, or I can never. They're so volatile and so up and down that I don't even remember when they rally, when they go down. It's a lot at this point.
Yeah.
So what is,
You're
especially
not the only one.
Sibanye, especially Sibanye, would you be buying or not?
Look, I think the PGM sector is in an interesting space at the moment. I mean, what you've had is the platinum price, if you look at that, flatlining for almost 10 years. But clearly the costs of extracting that metal out the ground have increased a lot. So that's put a lot of pressure on the profitability. There's been a lot of concern on the demand for PGMs when you consider the move potentially to electric vehicles. But I think recently what's interesting is that there's that's been tempered somewhat, because we're looking like the demand for EVs isn't as strong as expected,
Yes.
and actually hybrid vehicles that has both internal combustion and battery powered seems to be the way to go. And if that's the case, those hybrids definitely have a high demand for PGMs through their catalytic converters. So, rolling that all in, I think that actually the demand for PGMs might be higher than expected.
Yeah.
These companies have been through the ringer recently, but it looks like they might be coming out the other side. Sibanye's had some more issues themselves, with all of their steel making. They've now got the lithium project, which looks interesting to them, but yeah, I think it's quite a high risk stock to be investing in. It could work. But I think, as you said right up front, you've got to have the stomach for the volatility.
Yeah.
And my sense is that there's other players to look for there.
Well, actually, because that is the second part of that question, which PGM stock is best to buy? I guess that's kind of subjective, but on your front?
Yeah, of course. I think probably Anglo-American Platinum is the one to go for. Really, really high quality assets, lowest cost of production there. And I think if you are going into this, nail biting space, I think you want to back the quality. So that's the one I would recommend.
All right. Nail biting, that's something that beauty brands would not like to hear, because, I mean, they're trying to sell you like nail polish and stuff. Estee Lauder, your opinion on Estee Lauder at these levels. I feel like half of our analysts watch Estee Lauder and half don't. I know David Shapiro is actually like the cheerleader of like these beauty stocks. Where are you on that, Devin?
Yeah, look, I think I like that kind of smaller luxury play. So there's, as discretionary income increases, hopefully with easing monetary policy, so consumers have a little bit more to spoil themselves, and Estee Lauder clearly fits right within that. The company has had a tough old time, but it looks like it could be on the way up there. There are some concerns around their profitability at stage, but it seems to me that that's starting to recover somewhat. So yeah, I think it's an interesting place in the market, and I think it's one that investors can look at, but it's not one we're rushing into at the moment.
All right. Well, there is a question that just came through for gold. Would you be buying gold at this time? Does the environment look supportive?
So look.
Well, let's say the gold miners, yeah.
Yeah. And I mean, then you've got to look at the underlying gold price, of course, and there it's been massively supported by central banks buying that. We are seeing signs of that starting to slow. You do also have country-specific demand coming out of India and China. That's been okay. But all of this, coupled with geopolitical uncertainty, has pushed gold to its recent highs. Will that last? Sure. It's always difficult to say. My sense is it's probably done most of its running. And particularly then if you're looking at the gold miners, which are geared plays on the underlying yellow metal, I think you must be cautious. If there's maybe one or two of them that haven't run so hard, you could possibly insulate yourself from that a bit. But I do think there is risk here.
What about coal, Devin? Because I see that Thungela is up with 3% today. And it was quite interesting, what you said. And obviously, I think for the past few months, that has been apparent that, like, for example, PGMs is something that we thought were going to fade out at some point. The demand is actually higher than, is expected because just the demand for EVs has basically slowed. And I'm wondering about coal because we've also been asking the same thing about coal, that, when will it be phased out? What's your view there?
Yeah, it's I mean the move to renewable and green energy was well intentioned, but I think practically it wasn't fully thought out. We obviously then had the just because of the reliance on coal for baseload power in many emerging markets and even some developed markets. We then had the supply constraints with COVID that shot the price up, and Tugela was a great beneficiary of that. And coal's kind of settled back to more normal levels. So, my view on coal is not that we're going to see demand run away or fall off a cliff. It looks to be fairly balanced at this stage.
Okay.
And so I think in that regard, you can have a look at Tugela. I mean, it's screening very cheaply at the moment. There are reasons for it, and that is historic. But I don't think you're going to get the purple patch like investors had, after it spun out and listed. I think that easy money has been made, and probably now you're going to get a more moderate return profile. But these kind of industrial commodities, you look at iron ore as well. That's really ticked up massively with potentially the reemergence of the Chinese economy, and that I think there is still demand around, but I don't think it's run away.
All right. Well, let's run away to your stock pick for today, Devin. What are you choosing?
Yes, I'm not going to go the China picks that we've discussed before, though those have looked very good recently. I'm actually going to go for a change we've made recently in our global fund, and we switched out of the Russell 2000 ETF, which has had a nice run, into the S&P 600 small cap ETF. Now, this is an index that holds 600 US small caps. But the key differentiator that we like is that it requires the constituent companies to be profitable, whereas a lot of the companies in the Russell 2000 are not profitable. And if you kind of look on a 3-year rolling basis, go back quite a while, it's historically outperformed the Russell about 86% of the time. So it gives you an ETF in US small caps that really has a higher quality, but a more concentrated exposure. And I think that being a sector of the market that's highly rate sensitive, it represents a compelling opportunity, hence the reason for the switch into our global fund recently.
Very, very interesting one there. Thank you so much for your time and for your analysis today, Devin. Much appreciated. That is all for tonight's Stock Watch. Thanks to my guest, Devin Shutte from the Robey Group. Up next, the close. Stay tuned.